A new world disorder emerged with the US-China trade war, which began in 2018. This trade war was not just a series of economic skirmishes, but a reflection of deeper tensions between two global superpowers. It was a battle for dominance in technology, manufacturing, and global influence, with both nations vying to shape the future of the global economy. The trade war sent shockwaves through the global economy, disrupting industries and creating uncertainty in financial markets. Stock markets around the world reacted with volatility as investors grappled with the implications of escalating tariffs and trade restrictions. This conflict, marked by tit-for-tat tariffs on billions of dollars worth of goods, created a ripple effect that was felt across multiple sectors. From agriculture to technology, industries on both sides of the Pacific were caught in the crossfire, struggling to adapt to the new trade landscape. The trade war really exposed the vulnerabilities of global supply chains that had been built on decades of interconnectedness. For years, businesses had optimized their operations for efficiency, relying heavily on just-in-time manufacturing and global sourcing. But the sudden imposition of tariffs and trade barriers revealed how fragile these systems could be in the face of geopolitical tensions. The trade war brought to light the shifting dynamics of global power and the intensifying rivalry between the world's two largest economies. It was not just about trade deficits or tariffs, it was a contest for technological supremacy, with issues like intellectual property theft and 5G technology taking center stage. Its far-reaching consequences have had a profound impact on businesses worldwide, especially for those with manufacturing operations in China. Many companies found themselves caught in the middle, facing higher costs and uncertain futures as they tried to navigate the new trade environment. Companies have been forced to reevaluate their supply chains, assess geopolitical risks, and develop strategies to mitigate potential disruptions. This has led to a growing emphasis on diversification, with businesses seeking to reduce their dependence on any single country or region. Many have started exploring alternative manufacturing locations, particularly in Southeast Asia and other developing regions. Countries like Vietnam, India, and Mexico have emerged as attractive options, offering lower costs and a more stable trade environment. The trade war underscored just how interconnected the global economy is. It highlighted the intricate web of trade relationships that bind nations together, showing how a disruption in one region can have cascading effects across the globe. These disruptions have not only affected businesses but also had a tangible impact on consumers. Higher tariffs have led to increased prices for goods, from electronics to everyday household items, forcing consumers to bear the brunt of the trade war. The sight of empty supermarket shelves and rising costs has become a stark reminder of how deeply interconnected our world is. The US-China trade war has shown that in a globalized economy, no nation or individual is truly isolated from the consequences of such conflicts. As the world continues to grapple with the aftermath of this trade war, it serves as a cautionary tale about the importance of collaboration and the potential costs of economic nationalism. The lessons learned from this conflict will likely shape the future of global trade for years to come. For decades, China has served as the world's factory floor, attracting multinational corporations eager to take advantage of its low labor costs, vast manufacturing capacity, and access to a rapidly growing consumer market. China's rise as a manufacturing powerhouse didn't just transform global trade patterns, it also fueled its own remarkable economic expansion. Companies across industries, from electronics to apparel, flocked to China, lured by the promise of cost savings and efficiency. With a skilled and relatively inexpensive workforce, along with government incentives and significant infrastructure investments, China became an irresistible destination for foreign investment. The imposition of tariffs by both the US and China marked a significant turning point in global trade relations. These tariffs, which were essentially taxes on imported goods, were introduced as part of a broader trade war between the two economic superpowers. While the intention was to protect domestic industries and reduce trade imbalances, the ripple effects were felt far beyond the borders of these two nations. The finely tuned global supply chains, which had been developed over decades of globalization, were suddenly thrown into disarray. These supply chains, designed for efficiency and cost-effectiveness, relied on the seamless movement of goods across borders. The tariffs disrupted this delicate balance, creating bottlenecks and inefficiencies that rippled through industries worldwide. Over the years, global trade routes had been meticulously established to connect manufacturers, suppliers, and consumers across continents. These routes were the backbone of international commerce, enabling businesses to source raw materials and components from different parts of the world. However, the sudden imposition of tariffs forced companies to rethink their strategies, leading to delays, increased costs, and logistical challenges. The tariffs increased the cost of goods manufactured in China and sold in the US, making them less competitive in the global market. For consumers, this translated to higher prices on everyday products, from electronics to clothing. For businesses, it meant tighter profit margins and the need to absorb or pass on these additional costs. Companies that relied heavily on Chinese manufacturing faced a host of challenges. Shrinking profit margins were just the beginning. Many businesses struggled to maintain their supply chains as the increased costs and delays made it difficult to meet customer demands. Consumers, in turn, faced higher prices and reduced availability of products, creating frustration and uncertainty. The disruptions were not limited to just one sector. Industries ranging from technology to retail felt the impact. Delayed shipments, empty shelves, and logistical nightmares became common occurrences. Supply chain managers were forced to scramble for alternative solutions, often at a higher cost and with no guarantee of success. The uncertainty introduced by the tariffs also had a profound effect on global markets. Stock markets experienced increased volatility as investors reacted to the changing trade landscape. Businesses found it increasingly difficult to plan for the future, as the unpredictability of the situation made long-term investments risky. Trade conferences and meetings were dominated by discussions on how to navigate this new reality. For many companies, the tariffs served as a wake-up call. The over-reliance on a single country for manufacturing and supply chain needs was exposed as a significant vulnerability. Businesses began exploring ways to diversify their supply chains, seeking alternative sources and regions to reduce their dependence on China. The trade war highlighted the fragility of global supply chains. Assembly lines came to a halt, cargo ships were left waiting at sea, and store shelves remained empty. These disruptions underscored the need for greater resilience and adaptability in the face of geopolitical and economic challenges. The heavy dependence on China as a manufacturing hub had been a cornerstone of global trade for decades. However, the tariffs forced businesses to confront the risks of this dependency. As companies began to diversify their operations, the global supply chain landscape started to shift, paving the way for a more decentralized and resilient system in the future. Confronted with mounting tariffs and trade uncertainty, many companies began to diversify their manufacturing operations away from China. For years, China had been the world's manufacturing powerhouse, offering cost-effective labor, robust infrastructure, and a vast supply chain network. However, the escalating trade war between the United States and China, coupled with increasing geopolitical tensions, forced businesses to rethink their strategies. Companies faced higher costs due to tariffs, and the unpredictability of trade policies made long-term planning difficult. This created a pressing need to explore alternative manufacturing hubs. This shift, often referred to as China Plus One, involved setting up production facilities in other countries to reduce reliance on a single source. The strategy wasn't about abandoning China entirely, but rather about creating a more balanced and resilient supply chain. By diversifying their operations, companies aimed to protect themselves from potential disruptions, whether caused by trade disputes, natural disasters, or other unforeseen events. This approach also allowed businesses to tap into new markets and benefit from regional trade agreements, further enhancing their global competitiveness. Nations like Vietnam, India, Mexico, and other Southeast Asian countries emerged as attractive alternatives, drawing companies eager to mitigate risks and stay competitive. Vietnam, for instance, offered proximity to China, making it easier to integrate into existing supply chains. India, with its vast labor pool and growing infrastructure, became a key destination for industries like electronics and textiles. Mexico, benefiting from its location near the US and trade agreements like the USMCA, attracted manufacturers looking to serve North American markets. Southeast Asia as a whole became a hotspot for investment, with countries offering incentives to lure foreign businesses. While this relocation of manufacturing was driven largely by trade tensions, it also reflected broader trends, including rising labor costs in China and a growing desire for greater supply chain resilience. Over the years, wages in China have steadily increased, making it less cost-competitive for certain industries. Additionally, the COVID-19 pandemic underscored the vulnerabilities of over-reliance on a single country for critical supplies. Companies began prioritizing flexibility and adaptability, recognizing that a diversified supply chain could better withstand global shocks. This ongoing transformation marks a significant shift in the global manufacturing landscape, with long-term implications for trade, investment, and economic growth.